Hi guys, this is Craig, the Options Linebacker. This is the weekend report for Sunday, April 25th. I'm starting out today with a monthly chart of the Russell 2000. Now the Russell 2000 is a small cap index, and I think it's important to show what it's telling us right now. Now first of all, notice that in the monthly chart, the Russell 2000 has never lost the primary uptrend. So if you think about this, it has made higher highs, higher lows, higher highs, and yes, higher lows all the way along here. And it's now past the 76.4% retracement of the bear market. Chances look very, very good in the next few months of being able to go back up and at least retest those 2007 highs. Now, why is that so important? Well, you have to think about what's inside the Russell 2000 index, first of all. The Russell 2000 index is the small caps. These are the more illiquid small company stocks that are out there. These are not the GEs, these are not the Boeing Aerospace. If you want to sell out of a position and you're a fund manager and you have several thousand or perhaps even several million shares of one of these small cap stocks, you will move the market. So the fact that they're very, very bullish right now, this is the strongest chart that we're following, tells me that fund managers are very bullish right now and that these fib levels are just an ornament right now in the way of this being able to make a higher high at some point here in the near future. The other thing that we can see on the Russell 2000 chart is if we go back to the last recession from 2000, it lost about half its value during the downtrend on this recession. It was a very choppy affair, but after about 12 months, you can see that it took the prior high swing back. So it actually came back up faster than it fell down. And you can see that this is almost the case that we're seeing so far, is that after this move down, which was a very choppy affair, that it's almost gotten back up to this level in about 12 or 13 months, and it's actually rebounded faster than it went down. Now, if we zoom into the weekly chart on the Russell 2000, we can see that there may be some overhead resistance here at about 750, 760 because it was unable to get above those levels in 2008. However, what I don't think that we do have here is any kind of overhead supply that's sitting up in this level. Now, overhead supply is people that went long at a previous level and are just waiting to be made whole again. In other words, they're waiting through all of this mess to be able to sell out the position just so that they can cash out. I don't think that's happening. I don't think they've been sitting there on that position for the last 18 months. Most of the people washed out of their positions at the final low. So we can see at the last major resistance point, yes, we did have a little bit of a reaction at that point. In fact, that reaction was about a 10% correction. Not sure if we're going to expect to see another 10% correction here, but that would probably only put it down in this level. It would trim about 75 points off of the Russell 2000 at that point, and then we'd probably just continue onwards and upwards. As we zoom into the daily chart, we can see that the Russell's really not paying any attention to these bearish divergences on the MACD histograms. But one thing that worked out very well was to wait for this Bollinger Band squeeze. And you can see that it did explode higher out of that Bollinger Band squeeze that we talked about at the beginning of April. The Russell is respecting the Bollinger Bands. Anytime the Russell gets outside of the Bollinger Bands, it tends to trade back inside within the next couple of days. We've seen this a couple of times over the course of the last few weeks, and right now the price is right up against that upper Bollinger Band yet again. So it's important to watch the Russell these days because the Russell itself is absolutely leading the market, and we're using that as fund manager sentiment right now. Now here's the monthly chart on the S&P 500, and we have an important level coming up that we've been watching for a long, long time, which is a 61.8% retracement. So what I've been saying is that chances are that we'll see some type of reaction as the price gets up to this retracement. However, if it gets over this, then what it does is improves the probabilities of filling up that entire triangle. Now at this point, what I'm going to have to say is that based on the way that the S&P has misrespected any of these other fibs, I don't think that the 61.8% retracement is going to have any effect as it approaches here at 1228. I think what we're seeing is that this rally will eventually hit these all-time highs here up over 1500. I don't know whether that's going to happen this year, and what I've been talking about is for a long time is like this thing is not going to just go from a higher high to a lower low back up to a higher high, but now I'm having to revise that somewhat, but we'll have to see what happens with that 61.8% retracement. I think what we will see is something similar to this, is that the first move off the bottom is very strong, as this one has been over the last 13 months now, and then it'll move into a little bit slower of an ascent, and that would look something like this. And I think what'll trigger that off is when the Fed actually does have to start raising rates, and it could be a little sooner than we think, because we're starting to see a lot of economic numbers turn up. And then the final push will be very, very strong, similar to what we saw in 2007. And if we go into the daily chart on the S&P, we can see how the Bollinger Bands have really defined the upper edge of this. Anytime it gets outside of there, it gets pulled back inside. But the 20-period moving average has really been the support for this rally all the way up here, as divergences have been ignored to this point. If we keep zooming in on the S&P, I'm going to look at the futures contract here, because it does trade essentially 24 hours a day during the trading week. What we're seeing is that we're getting consolidation and a breakout above a horizontal price level, more consolidation, a dip before a move up to the next level, and that's important. We'll talk about that in a second. And then consolidation in that level. You can see the consolidation levels are getting a bit more volatile. This is more of a broadening pattern, which can be bearish, but it can last longer than we expect. And then within the context of these stair-stepping levels is this whole ascending channel that the price has been trading within. So we can see that on Friday, as the price closed, it went up into the next level. So it's just kind of stair-stepping up these boxes on the way up. Now what's really interesting is to watch this price action during the day. And I've zoomed in on this so you can just see the last few days, is that we'll see once we break out above a level, we'll see a little bit of follow through on there and then a drift back down. And what this drift back down does, this allows the prior bulls to be able to take profits, and what it also does is it encourages new weekend bears to go short on the market. But what's happening down here is that bulls will reload again on that and drive it much higher. So we'll drive it higher and then we'll consolidate for a while, and then you almost think that at some points that you've got some big hands that are pushing this down just to get new bears fired up again about going short on this chart. And of course, when we get down to support, that's where the big boys step in again and drive this chart much higher. So we're seeing the same pattern again, that this chart's moving higher because bears are being forced to cover intraday. Now I want you to notice on this chart there's no indicators on here right now. I don't think there are many indicators that are really working all that well, especially anything like oscillators. And we've seen that MACD divergences can go on forever without actually creating a signal, so that's really untradeable as well too. The only ones that are really working right now are things like Bollinger Bands or any other volatility-based indicators that let you know whether or not something's gone just a little bit too far, too fast. And that's it for today, folks. Have a great weekend. We'll see you next weekend.